Let's face it, investing can feel intimidating. Stocks, bonds, derivatives, it's enough to make anyone's head spin. But what if I told you there's a way to invest smarter, not harder? Enter mutual funds. Think of a mutual fund like a basket of stocks or bonds. Instead of buying individual stocks, you buy shares of the fund. This gives you instant diversification, spreading your risk across multiple investments. It's like having a personal team of experts managing your money. Net asset value, or NAV, is the price per share of a mutual fund. Expense ratio. Every mutual fund has costs associated with managing the fund. Mutual funds offer a simple, accessible way to participate in the market and grow your wealth over time. Just like there are countless varieties of coffee, the world of mutual funds offers a diverse menu to satisfy every investor's palate. Let's break down the most common types. Stock funds. These funds invest primarily in stocks, aiming for long-term growth. Growth funds focus on companies expected to grow at above-average rates. Value funds seek out undervalued companies, hoping their stock prices will rise. Bond funds. These funds invest in bonds, which are essentially loans to governments or corporations. They're generally less risky than stock funds and provide regular income. Index funds. These funds simply track a specific market index, like the S&P 500. They offer low fees and are a great option for passive investors. Actively managed funds. These funds have a portfolio manager who actively buys and sells securities. However, they often come with higher fees. Target date funds. These funds are designed for investors saving for retirement. They automatically adjust their asset allocation as you get closer to your target retirement date. Before investing in any mutual fund, it's crucial to do your homework. Use reputable websites like Morningstar or Yahoo Finance to compare different funds. We all know there's no such thing as a free lunch. The same goes for mutual funds. While they offer a convenient way to invest, it's important to understand the fees involved. Here are the main types of mutual fund fees you need to be aware of. Expense ratios. This is an annual fee charged by the fund to cover operating expenses. Lower is always better, so aim for funds with expense ratios below 1%. Sales loads. Some funds charge a sales commission when you buy or sell shares. No load funds, as the name suggests, don't charge any sales loads. 12b1 fees. These are annual marketing and distribution fees deducted from the fund's assets. Redemption fees. Some funds charge a fee if you sell your shares within a certain time frame. Remember, fees matter. Even a small difference in expense ratios can make a big difference in your returns over the long term. Always compare fees before investing and opt for funds with low expense ratios and no unnecessary loads. We get it, you want your money to grow. When evaluating mutual funds, past performance is often the first thing investors look at. But before you get blinded by shiny returns, let's understand how to interpret them properly. First, don't chase past performance. Just because a fund has performed well in the past doesn't guarantee future success. Market conditions change, and past performance is not necessarily indicative of future returns. Second, look beyond short-term gains. It's more important to focus on long-term performance, ideally over 5 to 10 years. This will give you a better understanding of the fund's consistency and ability to weather market volatility. Third, compare apples to apples. When comparing returns, make sure you're comparing funds within the same category. Compare the fund's returns to its benchmark index. Focus on finding funds with consistent long-term track records and the potential to grow your wealth over time. Every investment comes with some level of risk. Understanding your risk tolerance, your ability to stomach market ups and downs, is crucial before choosing a mutual fund. First, high risk, high reward. If you're young and have a long time horizon, you may be more comfortable with higher risk investments like growth funds. These funds have the potential for higher returns but also come with greater volatility. Second, moderate risk, moderate reward. Balanced funds, which invest in a mix of stocks and bonds, offer a middle-of-the-road approach. They provide some growth potential while mitigating risk. Third, low risk, low reward. If you're risk-averse or nearing retirement, you may prefer low-risk investments like bond funds or money market funds. Diversification is key. Spread your investments across different asset classes, stocks, bonds, real estate, and geographies to reduce risk. The key is to find the right balance of risk and reward that aligns with your financial goals, time horizon, and risk tolerance. Ready to put your knowledge into action? Here's a step-by-step guide to help you choose the right mutual funds for your investment portfolio. First, define your goals. What are you saving for? Retirement? A down payment on a house? Knowing your goals will help you determine your time horizon and risk tolerance. Second, determine your risk tolerance. How comfortable are you with market fluctuations? Are you willing to take on more risk for potential higher returns, or do you prefer stability and income? Third, choose your investment style. Do you prefer active or passive investing? Active funds have a portfolio manager who actively buys and sells securities, while passive funds track a specific market index. Fourth, research and compare funds. Use online tools like Morningstar or Yahoo Finance to compare different funds within your chosen category. Look at historical performance, expense ratios, and the fund manager's track record. Fifth, read the prospectus. This document provides detailed information about the fund, including its investment objectives, strategies, fees, and risks. Sixth, start small and diversify. Start with a small investment in a few different funds and gradually increase your contributions over time. By following these steps and staying informed, you can build a diversified portfolio of mutual funds that aligns with your financial goals and helps you achieve financial freedom. Investing in mutual funds can be a powerful way to grow your wealth, but it's important to avoid common pitfalls that can derail your financial success. Here are some mistakes to steer clear of. First, ignoring fees. Those seemingly small expense ratios can eat into your returns over time. Always compare fees before investing and opt for funds with low expense ratios and no unnecessary loads. Second, chasing past performance. Past performance is not a guarantee of future results. Don't get caught up in short-term market swings. Instead, focus on finding funds with consistent long-term track records. Third, overlooking risk. Every investment comes with some level of risk. Make sure you understand the risks associated with a particular fund before investing and that it aligns with your risk tolerance. Fourth, failing to diversify. Don't put all your eggs in one basket. Spread your investments across different asset classes, industries, and geographies to reduce risk. Fifth, timing the market. Trying to time the market, buying low and selling high, is a fool's errand. Instead, focus on a disciplined, long-term investment strategy. By avoiding these common mistakes and staying focused on your long-term goals, you can navigate the world of mutual funds with confidence and achieve financial freedom.